The government's multi-billion-dollar NBN deal with Telstra is now out in the open, but has failed to inspire financial markets. Telstra's share price had been rising in anticipation of the deal, but today fell more than 2%, and credit ratings agency Moody's has threatened to downgrade the telco. The agency says there are concerns about Telstra's margins in the future. Here's Philip Lasker.
Make no mistake, the world is watching to see whether Australia's digging a huge hole for itself.
It will be discussed at the OECD in Paris next week. We're really talking about the transformation of the economy.
But the talk among long-time Telstra shareholders like Jeff Reed was one of relief that some uncertainty had been removed.
I think it's the best possible deal in the circumstances when Senator Conroy was holding a double-barreled shotgun to the executives' heads.
To get something out of it, to get essentially it's about $14 or $15 billion in cash over 20 years out of it is better than the alternative.
Strip away the extras and Telstra gets $11 billion progressively over 30 years as its services are migrated to NBN Co. Optus gets $800 million for migrating its customers from 2014. Telstra gets a maximum $500 million break fee if the government changes policy or there's a new government, provided the NBN has reached more than 20% of homes. But investors are now left wondering what Telstra's margins will be when it's effectively a reseller on the NBN in 10 years' time. Margins are 40% plus now.
Exactly where it gets to depends on the mix of businesses that develop over that time, but probably it'll be somewhere in the low 30% range, and that's a mix which includes the fixed line business going to 20%.
Late today, credit ratings agency Moody's threatened to downgrade Telstra because the NBN deal raises concerns about the extent of margin compression after the company loses its monopoly operating position. But the industry's big players had nothing but praise.
We think it gives us the regulatory certainty going forward so that we can go forth and grow and prosper as a company.
It will provide the level playing field in the fixed line market, which a vertically integrated Telstra could not and would not ever provide.
Analysts are now speculating on Telstra's future.
It will compete, and not just with Optus, with IBM, with EDS, with Google, with Hewlett-Packard, as well as, of course, with the telcos. So it's a whole new game for Telstra.
The next couple of years are going to be good for Telstra. They'll be getting some pretty big payments from the NBN company, but after a while things will get tougher.
The deal needs approval from the tax office, the competition regulator and shareholders. There's some confidence Telstra shareholders won't stand in the way once they see an independent expert's report on the deal.
Subject to their favourable report, I would expect it to get through at the AGM.
The market reaction wasn't favourable. Telstra's share price fell more than 2% to a 5-week low, while Optus's owner Singtel went the other way.